So I'm going to touch on a few of the building blocks here. We have already seen a very immediate application using just the asset-based approach, right? I'm going to be touching on the next two categories. So the market-based approach is very interesting. It can encompass a whole lot of measurement that we're talking about. Just what are the important ones that a retail investor can focus on? And this is where I say 4 multiples every value investor must know. The learning outcome will be to evaluate a company's value using the market approach. Okay. Firstly, we come back to this, which I've already talked about, the price to book approach. Now, anything that begins with price is essentially comparing the market cap towards something else. Looking at the market cap as the numerator, I divide it by the value that's available. In this case, the book value. So essentially, what we're looking for is that in a number like that, like I mentioned earlier on, I'm not looking at price to book 8 times. What does it tell me? Price to book 3 times. What does it tell me? Actually, the defining criteria is at 1. If it's below 1, it's what kind of stocks. If it's above 1, it is what kind of stocks. If you value based on cash, which is very much the best valuation available, right? No judgment involved, it's about cash. Total assets kind of valuation after paying off liabilities is 1. Usually it's about 1. When you are someone who knows your work and you look at the numbers, they can differ from companies to companies, and it provides contrasting studies. So share price over earning per share, or sometimes you simply just use market cap divide by net income. So basically what we interpret about this ratio is that it approximates the number of years it takes for the earning to recover the investment that you make on that stocks. And really no consideration is taken on earning volatility, or we don't even talk about compounding of return for that matter. It is simply a very quick and easy manner where we make a judgment. Low PE, cheap. High PE, expensive. But things are not so simple, right? Because guess what? When I'm an analyst and I want to build a case, I can always come up with a PE ratio that can support my buy call or my sell call or hold outperform. I simply need to change it from historical PE. I change the story to forward PE, right? So you notice the research report also goes somewhere like that, that based on my forward PE analysis, this stock is attractively priced right now. What does that mean? Right? It simply means that in the next 6 months, I forecast that the next quarter's earning is going to be like that. All right? Or I can forecast trailing 12 months. Or no need to forecast. In this case, I can take the trailing 4 quarters number, add them all up. Then what you see is PE ratio, bracket, TTM. Every single stock commands a certain PE, and it can never drop below that PE. There are some stocks which will perpetually have a PE of 3 to 4 times. They are not cheap. All right, they just happen to belong to this category. So that's where you need to evaluate every single issue. And the trick about evaluating PE ratio is that one of the things, the very starting point is to convert it into a percentage, right? Convert into a percentage called earning yields. Earning yields is simply, PE is what? PE is price over earning per share. Earning yields is earning per share over price. You inverse it, right? You inverse it, it becomes a percentage, right? So this kind of give you an idea. First portion, right? The next portion will be to measure it against, you must choose the correct comparison. right? You don't choose to evaluate a CIMB bank with Nestle because it is not an apple-to-apple comparison, right? It has got to be the same segment. And then, most importantly, you must compare it against himself. Over the history of these stocks, what has been the PE ratio like? So 10 years will give you a very good picture of where this stock commands a certain PE. Sometimes in times of market correction, you get to buy at attractive PE because the company's earnings are not affected, but the share price has came down, right? So that is quick and easy. Dividend yield, annual dividend divide by current share price. Again, we are comparing it against a market pricing, right? Anything that we compare against market pricing is a multiple. This dividend yield is a moving target also because share price changes day to day. And what that means is that if you buy a stock that has got a lower dividend yield, you may not be appropriately compensated, right? You may not have bought it based on an income approach. The importance of dividend to a company is this. Any single money that is reinvested back and not pay out, just give the company more resources, more cash to reinvest the business. The moment that a company discloses that this year's dividend payout will be affected, right? Share price drop. And in such situation, why is this a very important numbers to look at? As value investor, you know that in a lot of cases, this knee-jerk reaction are opportunity for you. So these are some of the virtue, I will call them, or the advantage. And one of which is this. In the absence of other returns that you can get from your stock investment, every single dollar that you collect back represents a reduction in your capital at risk, right? It represents that whatever that you invested in, you have already collected back some money. And for stocks, which has been around for a long time, if you are a long-term investor, some of you are probably more than 10 years, 15 years, you might have stocks that you're holding on to that have repaid the original principal that you left when you invested in the stocks. Okay, you could have invested $1,000 and the dividend has already exceeded that. Okay, so that's why dividend sometimes can be a very important source, and it could be an important source of investment for someone who want to execute bagging a fast-moving elephant approach. So likewise, dividend yield has got these three aspects of it. The current, the forward, and the trailing 12 months dividend yield. And likewise, the same nuances that concerns PE ratio would apply for a dividend yield as well. What you would like to do is to make sure that you rely on numbers that you can see, right? But more accurately, you would like to look at what is the fiscal year end of the company, right? The fiscal year end, and between this fiscal year end and the last fiscal year end, what are the number of cents of dividend that the company has paid out? Next, I'll move on to this ratio that's called the enterprise ratio, right? And EV over EBITDA. So PE ratio measures your value, but the enterprise ratio measures the whole company's value, right? Which is why it's a measure of a company's profit without considering leverage and interest costs. Accounting policy is taken out, tax burden and tax rate is taken out. If you look at this number that says EBITDA, right? It stands for earning before interest, taxes, before depreciation, before amortization. Okay? So that's why it's called EBITDA. Right? So in other words, we are using a number that belongs to everyone, creditors and shareholders. But when you use net income, net income belongs to you already. The moment we arrive at net income, is left over for you already. That net income numbers, the whole claims belongs to you. So this is an exact calculation of how you will do it in terms of computing the EBITDA. So it's very simple. The numbers, I have purposely leave it step by step. So the way to calculate enterprise value, market capitalization, add that, add in minority interest, add up the preference shares, minus off cash and cash equivalent. Now why minus off cash? Because if you are a private investor and you are putting on the hat of someone who wants to buy over the whole company, you will assume the debt. You will assume all the liabilities that you own to all the preference shareholder, all the minority shareholder, but whatever cash that's found in the safe is yours to keep. So this is a more comprehensive method of valuation, taking into account tax policy, capital structure, account, and let's just put it the word to use for this term is called accounting policy neutral. This is a number that I can go cross market. It's useful for cross-national comparison like I just mentioned, and it's useful for identification of undervalued companies as target for takeover or for merger and acquisition. And most of which value investor, if you know this number, it will come in very handy, because when you measure, PE is not accurate, right? PE don't look at the whole picture. This one does look at the whole picture more accurately. And the reciprocal of the enterprise multiple is also sometimes referred to as return on investment. EBITDA over enterprise value is return on investment.